This is a short description of futures curves. So the graph at the top of this page shows us the futures price for a contract that expires in 1 month, 2 months, 3 months, etc., all the way up to 6 months, or in other words, delivery date in 1, 2, 3, 4, 5, or 6 months. That means we can purchase this futures today, which expires in, let's say, 6 months, and that means that the oil would have to be delivered at 6 months. So according to this, what is the spot price? It's the true price today, $65 a barrel, or according to this, maybe $70 a barrel. What is the price for a futures contract for delivery 6 months from now, according to this? Approximately $90. So that's this value right up here. So we're thinking if the price for oil delivered 6 months from today, the price today for oil delivered 6 months from today is $90. The price for oil delivered today is roughly $70. Note that although this slopes upwards, the futures curve can also slope downwards. It could be the case that we think oil is going to be worth less in 6 months than it is today. This one suggests that speculators think that oil is going to be worth more. Maybe demand is going to increase in 6 months. Here we think demand might decrease. So what if all of a sudden OPEC unexpectedly announces it will increase oil production? That's going to be an increase in the global supply of oil, which means that's going to shift the supply curve outwards, which means that the price of oil should come down. And we should see that reflected in the futures prices. And so this graph kind of indicates what might happen. If the green line was before the announcement, the purple line would be after the announcement. So we would expect that the futures price would come down for all subsequent months. What happens over time? As the delivery date approaches, as we get closer to the expiration date of these futures contracts, the price of the futures contract for delivery at T converges to the spot price at capital T. So capital T being the expiration date. So here we have on the left the graph of the futures price increasing. And here we have months from now on the right. The futures contract is $90 now for delivery in 6 months, but let's say the spot price over time is increasing. It starts at 70. The futures price. So let me say, okay, today the spot price is $70, but the futures price for delivery in 6 months is $90. As we get closer and closer to the expiration date, 6 months from now, the spot price, let's say, is increasing. Well, the futures price has to be then declining, and because they eventually must converge to the same price. Otherwise, the owner of that futures contract could do better by holding on to it or selling it, depending on the degree of difference between the spot and the futures price when they converge. Another way to think of this is if I'm the holder of the futures contract and I've held it all the way up until the expiration date, I don't want to take possession of that oil. I need to sell the futures contract because I'm an investor. I'm not an oil producer. And so what's the price I can sell my futures contract at that I bought 6 months ago that is going to expire at month 6? Well, if I try to sell it higher than the spot price, no one's going to buy it, right? Because they could just go to the spot market and buy oil. If I try to sell it lower than the spot price, people would obviously buy it because they could buy. That mean they would be buying oil at lower than the spot price. But there's no incentive for me to do that. So I'm going to sell it at the spot price. I have to get rid of that futures contract, and I need to sell it at some value. It's definitely not going to be below the spot price because that would mean that I could have made more money by selling it at the spot price. and it can't be above the spot price because no one would buy it.